So a lot of this sort of inflationary pressure isn't necessarily in our control as consumers, whereas previously, maybe you could argue the more of it was, and yet obviously raising interest rates or increasing interest rates is designed to sort of put downward pressure on inflation. So how will this be impacted? How will, I guess, inflation be impacted with this round of rate hikes as compared to previous ones?
Okay, so just a couple of things picking up on some of the things you said. Already, even inflation itself is going to have a downward place downward pressure on spending. And going to your point about discretionary and non-discretionary, what we've seen is prices for non-discretionary items rise at a faster rate, and so that means there's less money to spend on those discretionary items. Interestingly, though, people are still really continuing to spend at a pretty solid rate. So, as you know, the banks collect data on what people spend and what businesses, what's coming through on the terminals. And, when we look at that data, which, we've got it right up now until early August, you can see that people are actually still spending at a pretty solid clip. And they are still spending on discretionary items. They're still spending on big ticket items. So there doesn't seem to be any impact as yet. And when we look at New Zealand, obviously we have a fairly big operation there. Now, they have seen interest rates hikes since October last year. And again, we're not seeing in our spending data any real slowdown in spending data there, even though they've had much higher interest rates. So that is sort of interesting, I think, to see. But the way that interest rates, that they have a few channels that they work through. The main one is this cash flow channel, and that just means that people have to divert more of their income to mortgage repayments, so they have less to spend money on discretionary items. The other way it works is through the wealth effect, that people won't feel as well off because they won't feel that their home is worth so much. They'll see a home sell around the corner and think, oh, I thought that would have been worth more than that. And then they readjust their own expectations of what they're worth. And that flows through to consumer spending as well. And then we start to see that impacting on things like building approvals and how much people spend on building a new home or buying an apartment or doing renovations. You're much less likely to spend a truckload on a big renovation if you think your home's not worth as much. So it flows through in all sorts of different ways. The difference about this cycle is that we haven't had inflation this high since the early 1990s. Putting aside the period of the GFC, we just haven't had this problem for 30 years. And so it is a bit different. And that, I think, means that it creates a lot more uncertainty around forecasts. It creates more uncertainty for the RBA in calibrating its policy and working out, look, at what point do we stop doing 50 basis points and we move to 25? And at what point do we stop hiking? And it does create the environment where there is a possibility that they make a policy error, and they might not tighten enough, and they might find that inflation keeps getting away from them, and then they have to tighten very hard. Or they might come down too hard, and then we find the economy goes into recession. So it is a very, as Phil Lowe called it, a very narrow path through here, where they tighten at just the right pace to keep the economy on relatively solid ground, but get inflation under control.